And I'm here with our London bureau chief, London Baccardax, and our tech editor, Nelson Wang. Nelson, yesterday it was a huge tech sell-off. Can you talk to me about that?
Yeah, it was a real rout for tech stocks yesterday, and I think a lot of it had to do with the fact that these stocks have run up so much, particularly the FANG stocks, up 40, 50, in some cases 80% so far this year. So there were some concerns about interest rates, concerns about the China trade war, and there was a rotation out, I think, of tech stocks and into some safer seeming sectors like utilities.
And Alibaba was down. I mean, it's been down this whole week. What are your thoughts on that?
Yeah, so Eric Johns, our tech columnist, wrote a really good piece yesterday, sort of looking at the sum of the parts analysis. And so they are down quite a bit. They also are one of those sort of high risers or big risers of the last year or so, although the last few months it's been down quite a bit. But Eric did an analysis of all the pieces of things that they run and that they own, and found that they could be worth as much as, I think his number was about 50% or 55% more than what they're trading at currently if you just look at the valuation of all the bits and pieces of what they have. So there's obviously concerns about relations with China and tariff, but in terms of their businesses, they've still got a lot going for them. And
so when investors are thinking about tech right now, what's your advice to them?
Yeah. I mean, for me, I think this is like tech stocks are on sale. A lot of them got pummeled yesterday. Amazon is way off. I think it's about off almost 15% from its highs. So if you believe in these companies, that they're still going to be, the leaders in the economy, going to be transforming the way we do things, the way we buy things, this is a great opportunity to get in on a lot of these companies.
Okay. And Martin, I want to talk to you about the global stocks.
Mm-hmm.
What's your thought on that? I mean, they were all down.
Really, the ripple through in global stocks was very interesting because it followed on from what happened on Wall Street. But what I'm struck by is the way that Wall Street has changed this morning on the basis of that softer than expected CPI reading. So it sort of tells us that the interest rate story has been probably the most dynamic factor in the sell-off, which also inflected the tech stocks, as Nelson explained. But since the softer inflation probably predicates slower than expected Fed rate hikes, which are going to be influenced by the president's comments last night, where he told people that he thought the Fed was crazy, then you can understand why stocks are not so much bouncing back today, but at least paring their losses. But ultimately, the world is going to be looking at the interest rate dynamic here in the United States. But having said that, Nelson's point is an excellent one. The fact that prices for stocks change doesn't change the way we interact with these companies. People are not going to stop paying for things online because the stock market fell 800 points. So ultimately, the value in something like PayPal remains the same, and that's the same across the whole tech space. This is a revaluation from a market perspective based on what happens with interest rates. No change in the fundamentals. So as Nelson says, if you believe in this market, it's worthwhile to stay in, or maybe even better, come in at a lower level, dollar average, and actually increase your potential profitability going forward.
And what do you think that investors should be looking at today? Because, I mean, we're down about 140, I'm looking at it right now. And that might, as you said, pare their losses because of the CPI number, but what should investors be thinking?
Well, I think there's two things we should look at today. One has already happened with respect to the CPI, but there's also a 30-year bond auction from the Treasury today. And you'll remember that yesterday's 10-year Treasury auction sparked the accelerated decline. We had the highest level for a 10-year bond auction in 7 years, and the demand actually fell to the lowest level in several months. We may get a stronger 30-year auction today, and that's very likely to pull yields down. That will be another supportive factor for the stock market. The second thing I want to look at is probably not going to happen today, but into the weeks ahead, and that's the third quarter earnings season. The anticipation is that U.S. earnings are going to grow at about 21.3% over the third quarter. That will be the third consecutive 20-plus year-on-year gain for the S&P 500. That's astonishing. We are going to add $400 billion to the profit of S&P 500 companies, and that's going to flow through to investors. That's twice the rate of earnings growth in Europe. So it underpins the fundamental strength, not only of the U.S. market, but the U.S. economy. So we need to look at those two things. If interest rates are able to stay tepid and corporate earnings rise, that's a wonderful recipe for further gains into the end of the year.
I'm wondering, just as a final question for you guys, When it comes to any market sell-off, whether it be this one or any other one, what should investors look at?
I think ultimately interest rates are the story at the moment, and inflation, I think, is an incredibly powerful dynamic right now. Even though we've had oil sell off for 2 or 3 days, we're still looking at the highest prices in and around 5 years. In the United States, that's elevated gas prices to around $3.80 a gallon across the country. That does eat into consumer spending, but if we are able to maintain that level or even bring it down a little bit as a result of some of the trade policies that the president is pursuing right now, that again creates a nice dynamic. So I do believe, and I'll say this as a bond market veteran, so there's a bit of bias in there, but we need to understand and pay far more attention to what's happening in interest rates than we do sometimes with mergers and acquisitions and all the other fancy bits around the edge of the market. They do tend to be very important in terms of direction, and they don't tend to reveal themselves until days like yesterday in the form of an 800-point drop. But if you are in front of that story, you can protect yourself a lot better.
Yeah. And so Martin's looking a lot at the macro factors. I think for the tech stocks in particular, as he alluded to, the earnings season's starting now, and tech earnings will start in earnest next week with Netflix on Tuesday. So a lot of what's going to impact these tech stocks moves in the next couple of weeks is going to be the strength and quality of their earnings. How they're doing, relative to how they've been doing. Do certain trends with Facebook, Netflix, Apple, Amazon, Alphabet, are they sort of continuing to move in the right direction, or are they sort of tailing off, et cetera? So we're going to be watching those earnings really closely in the next few weeks.
And that's it for us. We're going to go check out the markets. Stick with us on The Street.